Have you ever stood in the grocery store, holding a carton of eggs that seems to have doubled in price overnight, and felt a quiet sense of rage? You look at the gas pump, and the numbers spin faster than a slot machine. You get your paycheck, and even if it's bigger than last year's, it feels smaller, it buys less, it disappears faster. You are working harder, but you are falling further behind. This feeling isn't in your head, it is a mathematical theft, and it has a name: inflation. Most people think they understand inflation. Prices go up, they say, and they are not wrong, but they are missing half of the story. They are only seeing one of the two monsters that are currently at war for the contents of your wallet. The other monster, the one nobody talks about, is actually far more terrifying. You have been told your entire life that falling prices are a good thing, right? A discount, a sale, a bargain. But what if I told you that a world where prices fall every single month is the stuff of economic nightmares? What if I told you that deflation is the disease that caused the Great Depression and could bring the modern economy to its knees? The average person is caught in the crossfire of this epic battle between these two opposing forces, and depending on which one wins, your entire financial future will be determined. The stakes are nothing less than your freedom. My name is John. This is the Penny Plan, and today we are going to pull back the curtain on the secret war between inflation and deflation. I'm going to show you exactly what they are, who gets rich, and who gets destroyed by each, and most importantly, how to build a financial fortress that can survive either monster. Before we break down the mechanics, we have to identify the real enemy. The enemy is not a political party. It is not a single person. The enemy is instability. Your financial life is like a tightrope walk over a canyon. Inflation is a strong wind blowing you to the left. Deflation is a strong wind blowing you to the right. The Federal Reserve, the central bank of the United States, is the person trying to adjust the tension on the rope while blindfolded. Think about it. The Fed has one job: to keep the economy stable. They aim for a Goldilocks level of inflation, about 2% per year. This small amount encourages you to spend and invest your money, because you know it will be worth slightly less next year. It keeps the economic engine humming. But managing this is like trying to land a 747 on an aircraft carrier in the middle of a hurricane. It is an almost impossible task. When they get it wrong, and inflation gets too high, like we have seen recently, they have to slam on the brakes. They raise interest rates. This makes borrowing money more expensive, which cools down the economy. But if they slam on the brakes too hard, they don't just stop inflation. They throw the entire economy into reverse. They risk summoning the other monster: deflation. Here is the part they don't tell you on the news. This entire system benefits the people at the top, no matter which way the wind is blowing. During periods of high inflation, who wins? People who own things. People who own real estate, stocks, businesses. Their assets inflate in value. Who loses? People who save cash. Your $100 in the bank buys fewer groceries. Inflation is a silent tax on the poor and the middle class who save their money in dollars. But what about deflation? During deflation, when prices are falling, who wins? People who hoard cash. If you have $1 million in cash and prices fall by 10%, your $1 million can now buy 10% more stuff. Your purchasing power explodes without you doing anything. Who loses? Everyone else. People with debt get crushed because their debt stays the same while their income and the value of their assets fall. Businesses go bankrupt because no one is buying anything. People lose their jobs. Do you see the trap? The average person loses either way. If you hold cash, inflation destroys you. If you hold debt, deflation destroys you. You are caught in a financial pincer movement. The enemy is the volatility of a system that is too complex for anyone to truly control. A system where the average worker is always the first casualty. To survive this war, you need to understand your enemy. We need to go deep into the mechanics of both inflation and deflation, and what they mean for your personal finances. Part 1. Understanding inflation, the thief in plain sight. We all feel inflation, but what is it? At its core, inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, the purchasing power of currency is falling. Your dollar buys less today than it did yesterday. There are two main types of inflation. The first is demand pull inflation. This happens when there is too much money chasing too few goods. Imagine a new video game console comes out, and everyone wants one, but the factory can only make 100,000. What happens? People are willing to pay more than the sticker price. The price gets pulled up by overwhelming demand. We saw this after the pandemic when people had stimulus checks and savings, but supply chains were broken. Everyone wanted to buy a new car or renovate their kitchen at the same time. Too much demand, not enough supply. The second type is cost-push inflation. This is when the cost to produce goods and services goes up. Imagine a war breaks out in the Middle East, and the price of oil doubles. Now, it costs more to transport goods. It costs more to run factories. It costs more to make plastic. Those higher costs get pushed onto the consumer in the form of higher prices. Your gallon of milk costs more not because more people want milk, but because it costs the farmer more to feed the cow and the trucking company more to deliver it to the store. So, who gets hurt by this thief? The biggest victims are savers and people on fixed incomes, like retirees. If you have $50,000 saved in a regular bank account earning 0.01% interest, and inflation is at 5%, you are losing $2,500 of purchasing power every single year. Your money is melting like an ice cube on a hot sidewalk. This is why keeping large amounts of cash in a checking account is a guaranteed way to lose. Who wins during inflation? Borrowers, specifically, people with fixed-rate debt. Imagine you took out a $300,000 mortgage at a 3% interest rate. If inflation runs at 6%, you are essentially paying back the loan with cheaper and cheaper dollars. Your mortgage payment stays the same, but your salary is likely to increase with inflation over time, making the payment feel smaller and smaller. Meanwhile, the value of the house you bought is probably skyrocketing. This is how the middle class in the 20th century built wealth. They used cheap, fixed-rate debt to buy an inflating asset. Part 2. Understanding deflation, the disease that paralyzes. This is the concept that is harder for most people to grasp because it seems like a good thing. Who wouldn't want their dream TV to be cheaper next month? Who wouldn't want groceries to cost less? But deflation is terrifying. It is an economic cancer. Deflation is the opposite of inflation. It is a sustained decrease in the general price level of goods and services. A little bit of deflation might seem nice, but when it takes hold, it creates a deflationary spiral. Here is how it works. Imagine you want to buy a new car that costs $30,000, but you hear on the news that car prices are falling. You think to yourself, why would I buy it today for $30,000 if it will be $28,000 in 6 months? So, you wait. Now, imagine millions of people all think the same thing. They stop buying cars. They stop buying houses. They stop buying washing machines. They delay every major purchase because they know it will be cheaper in the future. What happens to the car companies and the housing developers and the appliance manufacturers? Their sales plummet. When their sales plummet, they have to cut costs. What is the biggest cost for any business? Employees. They start laying people off. Now, millions of people are out of work. What do unemployed people do? They spend even less money, which causes prices to fall even further. This causes more businesses to fail, which leads to more layoffs, which leads to less spending. It is a death spiral that feeds on itself. This is exactly what happened during the Great Depression. Who gets destroyed by deflation? Borrowers. If you have that $300,000 mortgage and deflation hits, the value of your house might fall to $250,000, but your debt is still $300,000. You are underwater. At the same time, your salary is probably getting cut, or you lose your job entirely, making that fixed mortgage payment feel like a crushing weight. Debt becomes a ball and chain that drags you to the bottom of the ocean. Who wins in deflation? People who hold cash. If you have $1 million in cash under your mattress, and prices across the economy fall by 20%, you are suddenly 20% richer in terms of purchasing power. The cash itself becomes the best performing asset. This is why deflation is so rare. The entire modern financial system is built on a foundation of credit and debt, and deflation is the acid that dissolves that foundation. Part 3. The tug of war. The Fed's impossible choice. So you have these two monsters: inflation, the thief; deflation, the disease. The Federal Reserve stands between them, trying to keep both at bay. Their primary weapon is the federal funds rate, which is basically the interest rate at which banks lend to each other overnight. This rate influences all other interest rates in the economy, from your mortgage to your credit card. When inflation is high, the Fed raises interest rates. This is like putting a chokehold on the economy. It becomes more expensive to borrow money, so people and businesses spend less. Demand falls, and prices stabilize. But if they choke too hard for too long, they can kill the patient. They can trigger a recession and deflation. When the economy is weak and they fear deflation, the Fed cuts interest rates. This is like pumping adrenaline into the economy. It becomes cheaper to borrow, so people buy houses and cars, and businesses expand. Demand increases, which pushes prices up. But if they pump too much adrenaline, they can create a bubble and runaway inflation. The problem is that these tools are not precise. They are blunt instruments. It is like trying to perform surgery with a sledgehammer. There are also long and variable lags. A rate hike today might not fully impact the economy for 6 to 12 months. By the time they see the effect, they may have already gone too far. This is why the Fed is constantly walking a tightrope, and why they often get it wrong. Part 4. Your battle plan. How to build an anti-fragile life. You cannot control the Federal Reserve. You cannot predict whether we will have inflation or deflation next year. So, what can you do? You have to stop trying to be a psychic and start trying to be a survivalist. You need to build a financial life that is anti-fragile, a system that not only withstands chaos, but actually gets stronger from it. To survive inflation, you need to own assets that do well when prices rise. This means owning a piece of the productive economy. This means owning stocks, specifically in a diversified, low-cost index fund. When companies can charge more for their products, their revenues go up, and their stock prices tend to follow. You also want to own real estate, ideally with a fixed-rate mortgage. Your debt is fixed, while the value of the asset and the rent you can charge inflates. You also need to inflate your own income. You need to be acquiring skills that allow you to demand higher wages, keeping your personal earning power ahead of the rate of inflation. To survive deflation, you need two things: cash and low debt. Cash is king in a deflationary world because its purchasing power increases. Having a healthy emergency fund and a stable income becomes your lifeline. You also want to have as little debt as possible, especially variable rate debt. In a deflationary world, debt is a cancer that will eat you alive. Do you see the contradiction? The strategy to beat inflation is almost the exact opposite of the strategy to beat deflation. So what is the answer? You prepare for both. You build a balanced financial fortress. You own stocks and real estate for the inflation threat. You hold a 6 to 12-month emergency fund in cash and aggressively pay down high-interest debt for the deflation threat. You diversify your defenses so that no single economic outcome can wipe you out. Now, you have heard all of this. You understand the two monsters. You know the battle plan. So you might be thinking, okay, right now, inflation is the clear enemy. I should go all in on assets and take on debt. Or you might be thinking, a recession is coming. Deflation is the real threat. I should sell everything and hoard cash. This is the twist. This is the ultimate trap that destroys more wealth than anything else. The trap is thinking you are smart enough to predict the future. The average investor's greatest enemy is not inflation or deflation. It is their own emotional reaction to the headlines. When the news screams about inflation, people panic and buy things they can't afford. When the news screams about a market crash, people panic and sell their stocks at the bottom. The real trap is cash drag. This is what happens when you get scared. You sell your investments and move everything to cash until things calm down. But what happens? You sit in cash for a year, the market recovers without you, and all you did was miss out on the gains. Worse, if inflation is running at 5%, your cash lost 5% of its value while you were waiting. You locked in a guaranteed loss because you were afraid of a potential loss. You cannot time the market. You cannot outsmart the global economy. The financial media is not your friend. Their job is to get clicks, and fear gets clicks. They will always tell you the world is ending. The only winning move is to have a plan and stick to it with religious discipline. You create your anti-fragile portfolio, your mix of assets and cash, and you automate it. You contribute every single month, whether the market is up or down. You ignore the noise. You are not a trader. You are a builder. Builders don't stop construction every time it rains. They put on a jacket and keep working. The battle between inflation and deflation is a permanent feature of our economic system. It is a tug of war that will continue for the rest of your life. Trying to guess which side will win in any given year is a fool's errand. You cannot control what the Federal Reserve does. You cannot control global supply chains. You cannot control geopolitical events. But you can control your savings rate. You can control your debt level. You can control your asset allocation. You can control your emotions. The goal is not to become a macroeconomic expert. The goal is to build a personal financial system that is so robust, so resilient, that it doesn't matter what the economy does. You build your own fortress. You control your own destiny. You take your power back from a system that is designed to make you feel powerless. powerless. You now understand the game. You know who the players are, and you know what is at stake. The average person will continue to be a pawn in this game, pushed around by forces they don't comprehend. But you don't have to be average. You can be the exception. If this video helped you understand the forces that are shaping your financial life, make sure to hit that subscribe button and like this video. It helps us get this crucial information out to more people who need to hear it. Thank you for watching, and I'll see you in the next one.